Hello everyone. Welcome to Pitfalls of Trading, Shortcuts to an Effective Trading Strategy Part 2. I'm Jan Mota, Chief Market Analyst for TIO Markets. And before we move on, let me share this with you. This is the feedback that I'm getting at the moment. Sir, you have no idea. I'm really grateful for the content that you share with us. And I'm so glad you're back because you know what you're doing and I learn a lot. So I hope that this will encourage you also to pay attention to what I have to say, because clearly I'm adding value to what traders out there are looking for. They need strategies, they need understanding on how the markets work, how to develop themselves as traders. And this is what I'm here for. Now, TIO Markets does offer only consultancy-free service. We don't provide any investment advice. So the views expressed in this presentation are our opinions only, and they are made purely available for educational purposes and do not constitute advice or investment recommendation. So they don't in any way constitute an invitation to acquire any financial instrument or product. Please remember that TIO Markets and its affiliates and consultants are not liable for any damages that may be caused by individual comments or statements by TIO Markets analysis, and assumes no liability with respect to the completeness and correctness of the content presented. Yes, as traders, we need to know that we only are reliable. We ourselves are always responsible for our own analysis and actions. But hopefully this presentation will help you to develop your own analysis and trading further. Here's my background very briefly. I don't want to go much into it because you might have seen this in the previous videos already. In my current role, I'm here to help you. I've been assigned by TIO Markets to really take your trading to the next level. I want to help you. I want you to come back to me in a half a year's time and say that, okay, I'm taking so much better trades now. My account is turning around and I'm making pips. I'm really using the stuff that you are giving me to develop myself, and this really is what I'm looking for. This is the feedback that I'm looking to get from you guys. So, in this presentation, I want to touch upon some strategy essentials. What are strategy types? What means positive expectations? Positive expectation. It's something that, okay, let's go into it later. Market regime filters and risk management. Backtesting / forward testing, strategy evaluation and development. I don't know if we have time for all of this now, but if not, then we'll cover those things later. But I'm going to cover as much ground as possible now. I would emphasize that this is one of the major points in this presentation. It's essential to choose a strategy that fits your personality and schedule. If you have a personality that wants to get things done quickly and wants to have lots of action, can't sit around, can't wait for things to happen, then I would say go for something like scalping or day trading, where you need to be on your toes all the time, looking to take many trades and many signals. If that makes you alive, if that makes you tick, then definitely go for scalping or day trading. But if you are more of a personality who wants to take your time to do your analysis, really build up a case, and then take a trade, then swing trading or position trading is probably one of your strengths. We all should choose a strategy that is in line with our own strengths. If we hate the big sort of big positions, high gearing, lots of excitement and stress. If we don't like that, then I'd say let's choose swing trading or position trading. And another important factor here is obviously that your sort of existing work and your free time balance. How much time does the work take of your day? If you are working 8 to 10 hours a day, maybe even more than that, it's highly unlikely that you would be able to go and sit at the screen and take a lot of scalping trades. Day trading might be too difficult for you under those circumstances. You might want to wait for the markets to move to certain levels, then build up your positions and let the trades run for a couple of weeks maybe. So then you would be using the weekly charts. But if your work life does allow you to say that, okay, you're going to spend 2 or 3 hours around the session openings, say around the London Open or New York Open, you're going to stay at your PC for 2 or 3 hours and you don't have any other commitments and you're not too tired from the working day that's behind you, then maybe scalping can be something that you want to do, or day trading, where you're looking to take 10 pips. When you scalp, you take 5 to 10 pips, maybe 20 pips per trade. When you trade day trading, you're looking to have those intraday swings of, 20, 30, 50, 60 pips, maybe sometimes more if the market moves really big. But then this, as you can see, I hope that you start to see that there is no single strategy that is sort of the key to everything. There's lots of bits and pieces that you only know how to put together. I'm here to provide these bits and pieces to you, to give you advice, to help you to build up your strategies, to help you to understand what's important and what's not. When I started in this field in 1998, I was trading for a futures fund in London. All the trading happened based on computer models, and it was our job as traders to execute those trades. So at the time, there was only limited amount of information about trading strategies available or financial data. Everything was expensive. But nowadays, there's loads of stuff around in the internet. There's lots of information. There's lots of different strategies. There's lots of different people saying that, okay, this is it. Or this is 100%. This strategy is correct 100% of the time. So the challenge there is more than getting the information. The challenge is to filter the information, to know what's valuable and what's not. And what I'm hoping to do here is that with the combined package of my analysis at tiomarkets.com/analysis and on Tio Markets YouTube channel, the combined package of this analysis and the webinars will help you to have sort of big picture and all the aspects necessary for you to develop yourself as a trader. You will have the analysis and you'll have my help via the webinars. Okay, let's move on. Discretionary traders look at the market and consider different factors. They could be technical factors or fundamental factors. And based on those, they build up a case deciding what to do. So This is pretty much what I do when I share analysis with you. I look at different factors, different markets, how they are moving, what seems to be the sort of primary trend at the moment, what is happening with the money flows, what is happening with how the markets are reacting to fundamental news flow. So all these things come together and help me to decide, okay, this seems like a relevant picture for such and such market. And then I go and execute my trades based on these ideas. So I have the price action, I have the technical factors, and I have the luxury of looking at all of these together with the fundamental information. So these are the good sides of this approach. Obviously, the weaknesses of a discretionary approach is that you might not be available when you should be trading. You might be asleep, you might be out, you might be working, you might be having a dinner. And all these things can take you away from the computer or your phone exactly when you should be placing a trade. So obviously that's a minus, that's a negative. This would never happen with the systematic approach because you have been looking at the market, deciding that, okay, rules 1, 2, and 3 seem like worth including into my model. Then you go and backtest this model and see that, okay, these are relevant, but let's add rule number 4 also. Then based on those 4 rules, you backtest the system again and you realize that, okay, there's potential here. It has some weaknesses, but there's enough potential to include this into my trading toolbox. And then you run the system and then you are a systematic trader. The system takes trades whether you are at your PC or not. If you want to have a sort of full 100% reliability system, then you can hire a server and you can have your system running on the server. It's always connected to the internet and it executes the trade, all the trades according to those 4 rules, whatever happens in the world. You might be sleeping, you might be traveling, you might be doing all sorts of things, but still the system is trading fair. Then there's the hybrid system. But before we go there, let me just touch upon the weaknesses of systematic approach. No computer algorithm or EA is as creative and capable of deduction that a human brain. So you need to have very, very robust is the word I was looking for. You need to have a very robust system, well backtested, well evaluated, thoroughly evaluated, to make sure that it's worth following, because there will be periods when your system doesn't work or it produces losing trades. Obviously, another way of looking at this is that every system has drawdowns. No system works each and every type of market. And if you think of markets, you have those periods when the market moves sideways, is building a bottom, then the market breaks out from there, then the market moves up in a trend, then it runs into resistance and starts to move sideways, and then either moves further up to higher levels, or it rolls over and starts to trend down. So it is very, very difficult, almost impossible to create a system that works fine in all of these different markets. You need different systems for different markets. So there are periods when a system produces good results, good winning trades, but then the same system under different set of circumstances creates losses, and those losses are called drawdown. When you have 5 losing trades in a row, you start to think, is this going to be worth it? Am I going to be able to follow this strategy? Even though you yourself have back tested it and you know the weaknesses and strengths, there'll be times when you're thinking, oh my, it's producing another signal after all these losses. Am I going to take this signal? Is it going to be another loss? Or maybe you just decide not to take that signal, and then that would have been the right one to take as the market started moving in your favor and your system came out of drawdown. If you followed the system, but you didn't take the signal, so you're stuck. So these kind of sort of challenges come with systematic approach. Then there's the hybrid approach. You might have a system that you have backtested, but then you decide after each signal whether you're going to take it or not. And based on what I've just told you, you can understand that there are challenges to this method, but some people feel that it's good fit for their approach and personality. So if you have any questions, please email us at support@tomarkets.com, and we are happy to help you. And if you have any wishes that you'd like to sort of convey to us, let us know what would you like to have in the future videos and future webinars. What topics you'd like me to go through, and I'm happy to help you out. So I look forward to your emails. Okay, positive expectancy. This is a highly, highly important principle. Without this, you have nothing really. You just have a losing system. Most traders don't pay any attention whatsoever to this. But this is something, if you want to be a professional, if you want to be a successful trader, this is what you have to think about. And it is a simple principle, basically saying that the profits minus losses minus the cost of trading over the next X number of trades, it could be 100,000, 10,000, whatever, but over the next X number of trades, the profits must be greater than the losses and the costs. Whether it's by $100 or $100,000, it's obviously something that depends on your principle, how much money you have put on your account, and it depends on your strategy and your skill levels and everything else. But you have to get to a level where your profits minus losses minus the costs of trading are greater than zero. So if you make, let's say, $30 per trade 90% of the time, and you lose, say, $400 on that one, on those 10% of the time. So 9 out of 10, you make $30, $270. Then on that one single trade, you lose $400. So your system has a negative expectancy. So I've seen traders that turn, I've seen some clients to really take it from, I think, 90,000 to over 1 million, and then lose everything because the system worked for a while, but then it didn't have a long-term positive expectancy. Now, you want to make sure your system has it, and I do my best to help you in this, but first of all, we have to understand what this concept is all about. So there will be losing trades. It's okay to have the losing trades if you have positive expectancy. It's okay to risk money because over those 100 trades or 1,000 trades, your strategy makes money. So you have a trading edge. That's what this means. And so you just have to look at your losses and you have to look at your winning trades and then analyze them and see why are those losses occurring. Can they be made smaller? Maybe you have to risk maybe you have to accept smaller wins in order to make your system to have the positive expectancy, but it's highly important that you get there. Otherwise you're just losing both time and money, because money at the end of the day is time. You've spent time to earn the money, so yeah, okay, let's move forward. But positive expectancy, you have to get there, and by attending the webinars, by learning, by following my analysis, you learn bit by bit what to do. And you can always email us, send us your questions, and we are more than happy to help you in that with your questions. And before we move forward from this subject, let me remind you that there are different systems that make money. You might have a system, like I said earlier, that makes money 90% of the time and then loses everything and more 10% of the time. Or you might have a system that is only correct 35% of the time, but still makes millions. And that's because those systems are trend following systems. 7 out of 10 times, they lose money, but not too much, just a little bit. And 3 times out of 10, they really, really have big winnings. And those winnings are enough to pay for all the losing trades. And they are still so big that they create profits. And these trend following systems they have their challenges, and they are obviously not something that new traders want to have, because everybody wants to have 90% out of 90% winning strategies. But even if you have a strategy that's correct only 40% of the time, 50% of the time, you have risk management that is correctly tuned, then your system can be profitable. Next, I want to talk to you about market regimes and potential filters for recognizing them. So, first of all, what do we mean by market regimes? It refers to the market having different phases where it acts and moves differently. As you can see here, we have different periods. I'm going to zoom in a little bit so that it's easier for you to see in this video. Obviously, this period here is very different to the period over here. The market moves down and it moves pretty fast. Then there are other periods when the market is moving down, but it is moving down slower. There are swings as the market moves down. Here we just plummet lower. And obviously, from this high, the move down is really, really fast. So we would need to have some tools that help us to recognize what's happening in the market. If you're running a fully mechanical system, it's going to be kind of challenge to create a market filter that can adapt to all these different phases. But as a rule, I'm going to... As a rule, there are 4 different phases which go, and then they have subcategories, but let's concentrate those on the 4 main regimes now. So first of all, there's a downtrend. Market keeps on making lower lows and lower highs and trends lower. Then there are periods when market is creating a base. So it's moving sideways and institutions are accumulating their positions, and once they're done, they let the market go higher. Then comes the markup phase. The market is trending higher, sideways formation here, another move higher, then sideways, lower high, and moved down, and now we had a return move back to the general area here, and we could be seeing here a start of a new downtrend. Obviously we don't know, but I'm saying it could be. So we need something to help us to recognize what's happening. And if you are running a discretionary system or kind of a hybrid system where you can choose to follow the signals when you want to, then obviously that helps a bit. So let me give you some basic tools for this, and then later on we can dive deeper into those. And if you have any ideas in this front, I'd love to hear from you, because obviously it's an area where nobody is perfect and everybody can learn new things. First of all, obviously you can use moving averages. So if you have an uptrend, you often have fast moving average above a slow. So that could be your filter there. And if the fast moving average is below and both of those moving averages are pointing down, then you probably have a downtrend. If you have the moving averages going sideways and the price crossing the moving averages and then, it moving pretty much on sort of equal distance outside of the moving average, then probably you have a sideways move. But this is challenging. It's not simple and clear cut. Then you could use volatility, or maybe a downside volatility rather. So if you have a system that is, say, it is benefiting from uptrending markets, and it's been your strategy and the system, that particular system is built for uptrending markets, then once you start seeing some downside volatility coming into the market, then that could be your sort of regime filter indicating that perhaps this up move isn't going to last. That it's not going to last. It's probably getting mature. Then you might have computerized trading models where you have sort of portfolio of systems, and the equity curves of those systems could tell you that the market regime is changing. But if you're interested in this side of things, maybe you can get in touch and we can talk more about this, because it's kind of more advanced. Then obviously, if you are a discretionary trader, you can make your own observations and see when the markets are likely to move sideways and when they are moving up or down in trends. So these are obviously just examples of potential market filters. You might have some other suggestions which I would love to hear. So let me know if you have any. Just email me at support@tiomarkets.com. Risk management is something that most traders ignore, and that's why most traders lose money. Period. Now, risk management obviously means that there is a limit to every risk taken, so that you don't let the risk get out of hand, so that you have it under control, so that before you open a trade, you decide, okay, this is how much I'm going to put on, and if the market moves against me, this is where I get out. So basically it means that you never trade without stops. It means that you always have a stop in place. If the market moves down to level X and I'm buying, then I want to get out of this trade. If you are shorting or selling and the market moves up against you, there is a level where you say, okay, this trade isn't working and I have to close this trade and I have to go somewhere else to look for better opportunities, because obviously it doesn't make sense to fight the market. I always talk about Mrs. Market because I I find that all the traders are married to this Mrs. Market, and if you want a happy marriage and a rich marriage with her, then you should obey her. So each and every time she says something, you just said, yes, dear. And basically that means that if the market says, I'm going to go higher, then you don't sell. If the market says, I'm going to go down, then you don't fight against it and buy. Always go with the flow. Always go with the market. And if and when you are wrong, just limit your losses. Because the idea is to have the positive expectancy. You can't have the positive expectancy if your losses are bigger than your winnings. Because then, at least with other brokers, there are such things as trading costs. Come to TIO Markets, open a VIP account, and you don't have the trading cost. That is a huge advantage, and you should take that advantage and use it. So, the only trading cost, obviously, is your spread. There is that's given. So every market where you have a bid and ask, there is a spread between. Okay. How much should I risk per trade? Obviously, first of all, you decide, okay, I'm going to buy and I'm going to place my stop, say 30 pips away, or 10 pips, or 50 pips, whichever suits your style and strategy. Then you have to think, okay, if I'm trading with one contract, how much I'm going to lose if the market moves against me? And how much is that loss relative to my account? So I would say if you don't have this all figured out yet, and if you don't have the positive expectancy, you should trade very, very, very carefully. But even if you have started to make some money and you are becoming a constantly profitable trader, still you should be not risking more than 1% per trade. Run that for 30 trades or 50 trades, and then see if it makes sense to start risk 2% per trade. But if you start off by risking 1% per trade and you have this maximum risk limit per day at 3%, after which you stop trading and go and do something else, then you are protecting your capital. Then you make sure you are around tomorrow to trade again. Then obviously you need a risk per week, because otherwise you could have a bigger loss than you would like to have. And I always say, also have a total maximum risk that you are going to accept. It could be 25%, for instance. So if your account goes down to 25%, then you know that your system isn't probably running the way it should. Especially if you use these above values here, say max risk per trade 1%. Sometimes you might take only 0.5%, depending on the conviction you have on the trade and the setup. So this is your maximum per trade. And if your max risk per day is 3%, then it's going to be kind of difficult to get down to minus 25. Provided your strategy has any value to it, if your strategy has the capability of making money, then you shouldn't go down to 25%, because that would mean you have 25 losing trades in a row. Otherwise it's kind of difficult to get down to 25, if you see what I mean. So think about this. Think about your strategy and how good it is, how much you want to risk with this strategy, and whether you need to develop it further before you are ready to run with it. Once you see 50 trades or 30 trades at least where your system is making money, then maybe you can start thinking, perhaps I start risking 1.5%. If you have 100 trades and your system is still making money, over a suitable period of time, so that you have the ups and downs of the markets. You have different regimes in there. Market goes down, goes sideways, goes up, goes sideways again, comes down again. If you have those 4 regimes in there and your system is still making money, then maybe you can start thinking of risking 2% per trade. But it's all about the results. It's all about the feedback that you get from the market and get from your system, and only then you should be adding risk. That is, if you want to become a professional trader, somebody who's making money constantly. Let's then talk quickly about backtesting and forward testing. What does this mean? So basically, backtesting means that you have trading rules, you have ABC or 1, 2, 3 rules that you say, if the market does this, then I'm going to buy. If the market does that, then I'm going to sell at loss. And if the market is running with me and goes to a certain level, then I'm going to exit at profit. So once you have all these rules, you can go and test, maybe using a computer software, go and test them with the historical data. And you should be obviously testing it with not one dataset only, but maybe you want to run the test with several markets that aren't very highly correlated, and you want to include several months or maybe several years worth of data, so that you can see how your system is working under different market conditions and different regimes. And once you have a reasonable amount of data that you have tested with, then you can do some tweaking with your parameters, saying that okay, ABC wasn't enough. I'm gonna have ABCD and maybe something else as well to really make this system better. And then you run the test again with historical data. And once you have something that is suitable, that's something that has some promise and looks potential, then you can do go from historical data testing into out of sample testing. So you basically have, this could be done either with historical data, so that, let's say, all the data from today backwards is 100%. You take 60 to 70% of that data, that's your optimization data, and then the rest is your out of sample data, and you see how well your optimized system is performing with the data set that it has never seen. No optimization is done in the out of sample data. Or you could have the historical data as your optimization data, and then you test your system real time. You let it run real time and you see how it performs over a period. Now, this obviously is difficult if you don't have the skills, if you don't have the programming skills, but you can also go and create your system manually and see how well it works with the past data. And if it seems like it's worth more testing and studying, then you follow the markets from today onwards, i.e. tomorrow, next week, next month, next half a year, and see how well your signals would have performed. And obviously that means that you have to sit down every day and have very meticulous bookkeeping. But this is what the backtesting, forward testing is about. And obviously this is a very quick view on the topic, and there's so much more to talk about this, but let's leave it for later. Okay, let's finish off with the strategy evaluation and development. So you obviously need to take a break every now and then and look back and see what you've done well and what you can improve. So you need periodic evaluation. It could be on daily basis if you like, but at least every weekend. When the market isn't open anymore, it's much easier to sit down and see what you've done correctly, where you have gone wrong, what you can improve. And so On daily basis, make notes of your trades. Why did you take the trade? What went into your thinking? Were you feeling when you took those trades? Then take screenshots of the market before you take a trade and after you exit the trade. So, and maybe you can write a text on those screenshots so that you have even more to come back to later on. Then on Saturday morning, you have your trading diary filled with notes and screenshots and statistics, and you have something to study because that data is very, very, very valuable for you. It's even more valuable than all the market data because this data is about you. You as a trader can develop based on this data. So if you make a wrong trade, you should have reasons. You should have something to go back to and see the reasons why you actually took that trade. And then you can improve. If you don't have anything, if you don't have any notes, if you don't have anything to go back to, you can't improve. It's very difficult, at least. So there are enough difficult things in trading, so you don't want to add more layers of difficulty yourself. And one more thing. There is no such thing as trade that loses money being a bad trade and good trades making money. That's nonsense. You might have a trade that made money, but it was a bad trade because it was not in your trading plan. You did something, you took a trade when you shouldn't have, according to a plan that is, and you maybe used too much gearing, too high leverage in that trade, even though your strategy said something else. You made money, but you violated your rules. And if you keep on violating your rules, you're going to blow your account. Period. Keep on violating your rules and you're going to blow your account. So there is no such thing as good trades making money and bad trades losing money. Even a losing trade is a good trade if it's taken in accordance with your trading plan. Okay, and before we finish, I just want to quickly mention a couple of things. If you haven't done so already, go to our YouTube channel and subscribe to it so that you can get an alert each time I publish new analysis video. And also, you can go to tiomarkets.com/analysis and you can find lots of valuable analysis there. And we also alert you to new analysis in Theo Markets announcements, Telegraph's channel. So you might want to go there and make sure that you are part of it and you get timely updates whenever there is valuable new analysis available for you. And of course, we provide those VIP accounts, no more monthly fees, 0 per trade commissions. You only pay the spread when you trade. So this is something is astounding. It's something really good. I wish this sort of things would have been around when I started, but this is still very exceptional in the industry. Go there, go to our website, tiomarkets.com, and register for the VIP account. So, it's incredible. So, but enough said. Thank you for this your time here. I love these webinars. It's such a pleasure to be able to show you what works and what's valuable. I hope that you give us some feedback. You can email us support@tiomarkets.com and leave us a comment. And if there's something that you would love to see in the future webinars, let us know. And obviously, this webinar was very much just an overview on what there is, what's relevant and what's vital in a trading system, what you have to pay attention to. And in future webinars, we can dig in deeper to whatever subjects and topics that you have in mind, and a lot of the topics that we also have in mind and are going to share with you. So, my name is Jan Mota. I'm the Chief Market Analyst for TO Markets, and all there is to say is thank you for your time and trade safe.